Good morning and welcome to this Wednesday, January 6th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, we kind of got some mixed futures off of the Georgia runoff races for the Senate last night. It looks like the Democrats have captured one of those Senate seats, maybe both. Market is reacting in kind. We do see NASDAQ futures down pretty strongly, while Dow futures are actually up some. So I wouldn't be surprised to see a little bit of rotation if, as the day progresses, we expect both of those races to turn to the Democrats. Market's been discussing some of that, I think, recently, the fact that it could happen. And it certainly appears like it may happen. But we'll talk about that a little bit more in just a bit. First, I'm going to take you over to the Earnings Beats site. So if you are new to Earnings Beats, love to have you join our community. Just type in your name, email address, hit the subscribe button. No credit card required. Unsubscribe at any time. It's a free newsletter. Comes out Mondays, Wednesdays, Friday mornings. Really a lot of different topics discussed. Been talking a little bit about seasonality recently, but usually it's focused on earnings, relative strength, with some potential trading candidates thrown out there along the way. I think you'll enjoy it and you'll learn a little bit more about how we approach the market at Earnings Beats. Might be some things you can take away into your own trading strategy. But love to have you. That community is growing strong. Had a huge year in 2020. We really appreciate everybody supporting us, and we'll continue to give you some great information there. So name and email address and you're in. Looking at our portfolios, had a pretty good day yesterday. You can see the model portfolio made another jump, now up 206% in 25 months, 25 and a half months. Pretty impressive. Aggressive stocks also, or aggressive portfolio also doing very well. These last three portfolios, we initiated those after the model portfolio. Model portfolio was the first one. But you can see since inception on all of our portfolios, we've done very well versus the S&P 500. And if you're wondering about this, the since inception under the S&P 500 is since inception of each of the portfolios, not since inception of the S&P 500. We know better than that. And this quarter is not a calendar quarter. The quarter is based on our quarters in these portfolios. So they always run they start on the 19th of February, May, August, and November. So anytime you're looking at this quarter, like for now, it's running from November 19th through February 19th. That will be this quarter. Once we hit February 19th, then a new quarter will start. And the whole idea, because we get this question sometimes, why those dates? That's essentially when earnings season ends. So we're getting ready to go into another earnings season, right around the middle part of January. And then the reports really pick up as you go through the second half of January and into the first 10 days or so of the next month, or in this case, February. And then things start to slow down. By the time we get to the 19th, most companies have reported. So that's the whole idea. We want to make sure everybody's reported. We look at the best reports. We look at the relative strength. We look at the best industry groups. And then we put our 10 equal weighted stock portfolios together. So that's the reason for those dates. All right, let's take a look at what happened yesterday in the market. Dow Jones Industrial Average up 167, S&P up 26, NASDAQ up 121. Mid caps, pretty good day, up 33, 1.5%, easily outperforming the other three indices. Small caps, best yet, up 24 points, up 2.18%. And this is, I think this is a theme as we go forward. I do expect that we're going to see mid caps and small caps outperform in 2021. They've been doing it in 2020 as we wrap up 2020. And I think it's going to continue. These two groups are really beaten down. I think as we get through and past beyond the virus, I think those companies that were able to survive it, small, mid-sized companies, I think they're going to thrive as pent-up demand, surfaces. So I think mid-caps, small caps will continue to do well. Looking at our sectors, energy, materials, both having strong days, especially energy. Crude oil now up to $50 a barrel. Didn't think we'd see that anytime soon, but it's here. Energy making a little bit of move, bouncing off that 20-day moving average. Nice, very good action there. Materials breaking out to a new recent high. Nice uptrend in play. Materials continue to look good. Real estate pulling back, not looking so good. You can see this was one of the two sectors that actually went down on Tuesday. So real estate and utilities. And notice they're both defensive groups. So again, I think the relative strength continues to move not only into materials, because materials has done very well, but I think that relative strength really it belongs to those aggressive groups. And I think that's going to continue throughout 2021. As far as industry groups go, the exploration and production index, of course, that's in the energy space, was, I don't know if it was the top performer. I think coal might have been the top performer, but coal is such a volatile group. I rarely feature that group on here, even when it does lead. I think it's more important to see that exploration and production are outperforming and trying to make a breakout above that December high that we saw. That would be very encouraging if we could get that move, and maybe it comes today. We'll have to see. All right, let's keep moving on here. 10-year Treasury yield. It's been a while, but we got a one handle. Check out where we are on the 10-year Treasury yield right now. We are at 1.02%. So we have gone back above 1%. Talked about this recently. We've had this ascending triangle. This is a bullish formation. I expected the breakout. We're now getting it. This would measure up about 15 basis points to maybe about 1.12%. So that would be the initial move that I would expect. I don't know that we go straight there, but I do believe we're going to trend higher and eventually get to that level. I think further down the road, I believe we're going to go up and test the March high that we saw, which is a little over 130. And then I probably meander at that level and come back down and maybe trade between the 130 level, maybe for a while in 2021. That's what I would expect. So that is good news, though, because what this means is that money's rotating out of treasuries. I mean, that's why the yield goes up. It's a direct 100% all the time inverse correlation to the price of treasuries. That's a given in the market. If folks are buying treasuries, the yield goes down. If folks are selling treasuries, the yield goes up. So when you see a big move like this, 6 basis points, there's a lot of money rotating out of treasuries. And the good news is if you like the stock market, usually that money coming out of the treasury market finds its way into the stock market. That's one of the long-term relationships, positive relationships that we have in, when we look at various markets and look at the intermarket relationships. Whatever the 10-year Treasury yield is doing, generally speaking, that's what the S&P 500 is doing, especially over short periods of time, because that's where the rotation's taking place. So, we get the big move up here. I would not be surprised to see the Dow maybe have a big day today. Certainly financials, I'd be looking to have a pretty strong day. We'll talk about that in just a bit. But very good move, strong move here in the 10-year Treasury yield this morning. All right, talking technically, I want to go over some international, global markets today. I don't talk too much about global markets, but I believe we are in one of the best bull markets, global bull markets that we're going to have in our lifetime. I think it's in some areas of the world, maybe it's just starting. Probably been building off of the March lows, but really when you start making breakouts like the German DAX is just now doing, this can lead to some really significant gains going forward. And when you look at this DAX chart, one thing that jumps out at me, I talk about this all the time, the correlation to the S&P 500 is uncanny. And many global markets have a fairly strong positive correlation with the S&P 500, but I don't know that there's any stronger than the German DAX. And that's why I look a lot between what's going on in the US and what's going on in Germany, just because there's such a strong tie between our two countries. Look at the DAX in 2000 printing a high. Look at the 2007 high. I mean, it's exact, just like the S&P 500. We had the big drop beginning of 2003. We recover. You come back down. The only difference I see really is that this low in 2009 did not take out the 2003 low. Other than that, this whole secular bear market looks like the S&P 500 chart. And when did we break out and start the secular bull market in Germany? 2013, same as the US. So I think it's pretty important just to understand that these two markets tend to perform very closely and very much aligned with one another. And if you don't believe me, just go down here. This is a 25-year weekly chart going back to the mid 90s and look at the correlation between the DAX and the S&P 500. Only 4 times have we seen it go below 0 in 25 years. And look at how often we sit at 1, where we are talking about the markets go hand in hand. So if you're ever wondering, why I talk about Germany and don't talk about some of the other countries, it's because of the very, very strong positive correlation between Germany and the US. So Germany's just breaking out. You got to view that as a positive for the US market. Germany's breaking out. We tend to go with Germany. I mean, we've already broken out. Now Germany's following suit. This is good for the market. Forget about, the runoff election in Georgia. We'll talk about that in a couple minutes. But overall, big picture, start with that bird's eye view. Getting back to my article I wrote in Chart Watchers over the weekend, the bird's eye view, looking at it from space, looking at the Earth. That's kind of what looking at a 25-year chart, that's what it tells me. We're trending higher in the DAX. Every time we have a little pullback somewhere around the world, I read articles. It's like, oh, they're entering back into a bear market. No, they're not. I mean, look at the long-term trend here. The trend here is higher. If we hadn't had the pandemic, which nobody could predict, if we hadn't had the pandemic, this would be a very bullish chart, just continuing to rise, equal highs. This would have been rising lows. We'd have had a beautiful ascending triangle. We'd have broken out and be looking at, prices. I think just about any technician would look at the chart and say we're going higher. But the pandemic, obviously we had to deal with it. It was a once in a century kind of a thing. It did ruffle a lot of feathers. The market did break down for a period of time, but we came roaring back. It's all part of a secular bull market. All right, let's take a look at some of the other markets. I want to talk about the Hang Seng. So now we'll move over to Asia. And the Hang Seng, I mean, when you look back 2000, 2007, I mean, it doesn't look quite the same, the whole makeup. And in fact, the high that we saw in 2007, we've struggled to get through that high. That's not been a problem in Germany or the US. So these charts aren't the same, but you can still see mostly positive correlation. So let's go back and look at Germany. I want you to see how tight the positive correlation is on Germany. See how we're up near 1 almost all the time. Not a whole lot of up and down. Whereas when you get to the Hang Seng, you see more up and down. So there's not quite the positive correlation, right? Let's look at the Nikkei. Oops, I didn't get the dollar sign in there. Well, first of all, look at the last 25 years and look at what we've just done. Major, major breakout in Tokyo. And then look at the correlation. We stay mostly positive. Well, just broke out to a 25-year high. That's pretty important considering that the US market tends to go along for the ride, or the Nikkei tends to go along for the ride with the US, however you want to look at it. But I think it's pretty clear we got a nice secular bull market going on over in Tokyo. Now, here's one that might throw you for a little loop. And it's one of the reasons why when CNBC or whoever starts talking about what's going on in China and how that's going to have some kind of major impact here in the US, it was a little bit like with the China trade war. Everybody was so bent out of shape with the trade war. And yet, when you look at our two countries, I mean, look at the correlation here. It's almost divided. Maybe a little bit of a slant toward positive correlation, but look at all the times we go negative. It's very normal for our two markets to go opposite one another. So when everyone was so concerned about what was going on with the China trade war and what was happening in China, falling back here in 2018 and all, I was just like, from a US stock market standpoint, I don't want to say who cares, but Who cares? Based on the charts, these charts don't lie. I'm more concerned about what's going on in Germany than I am in what's going on in China. Now, maybe as we go forward, we've seen the last couple of years, China's trending higher. We've seen mostly positive. Maybe things will change over the next 5 years, 10 years. Maybe we'll become more positively correlated. But when we look at history tells us that we're not seeing positive correlation here. 2015 was a year of consolidation in the US. Look at China was going straight up. And then we break out and had a huge move, 2016, 2017 to all-time highs. We had a slight little move here. 2017 actually dipped for a while, even though the US was going straight up. And you can see the inverse correlation. So I just wanted to point this out. I believe that the markets that are critical to the US are all in secular bull markets and all either breaking out to new all-time highs in the case of Germany and over in Tokyo with the Nikkei, or they're strengthening. They're beginning to strengthen with the Hang Seng. And again, the fact that China is going up, well, that maybe helps. But looking at this, it's more of a 50-50 proposition. Just because China is going up doesn't mean we're going to go up. The last one I'll show you is the emerging markets, the EEM. A lot of folks write to me sometimes asking about emerging markets. Look at the correlation here. Pretty tight positive correlation between the emerging markets and what goes on in the US. And what is the emerging markets doing right now? It's breaking out to a new all-time high. So huge, huge rally in this area. So when you start looking at the big picture and you start looking at correlations and what really drives the US stock market and vice versa, US drives other areas, it's hard for me to be bearish. Point to something that's bearish on these charts. I'd like to see it. There just isn't anything. Technical analysis, when you're breaking out the all-time highs like you are in the EEM, where do you draw something negative out of that? Anyhow, one last thing I'll show you, because this is important, and I got a question about copper versus, I guess I could have saved this for the mailbag, but I've gotten questions before, and a recent question about copper versus the other metals, gold and silver and so forth. And I'm much more bullish on copper than I am gold and silver. Gold and silver tend to be driven more by, especially gold, is driven more by fear and the direction of the dollar. And so if we're in a secular bull market and we're going to break out and we're going to have a good 2021, which I believe we are in terms of the S&P 500, we're going to see fear dissipate. So one of the, check marks in the gold column is going to be gone, in my opinion. When fear dissipates, gold tends to underperform. So that's point number one. Point number two, I'm not going to have time to go into it today, but I believe the dollar is going to rebound. And I pointed that out at Market Vision 2021. I've talked about it recently, but just some of the charts that I follow are telling me that the dollar is going to rebound in 2021. And if that happens, that's another check mark gone in the gold column. Copper sometimes can see headwinds from the dollar. I think it can slow it down, but copper is driven a lot by global economies. And as global economies begin to strengthen, the price and the demand for copper goes up. And so I expect gold or copper to go higher. And down here at the bottom, you can see copper relative to the S&P 500. Do you see the positive correlation? Very strong positive correlation. If I pull up gold, look at the correlation. It's all over the place. We had more positive, I guess, maybe more positive back here. Gold was going up some with the S&P 500, but also the thing you have to remember is the dollar was going down. Since 2011, the dollar's been going down mostly. And so gold over these last 8 years, you might look at this and say, wow, gold's been going up. Gold's a great place to be. Well, gold's right about where it was 8, 9, 10 years ago. The S&P 500 is way above where it was 10 years ago. Would you rather be in gold the last 10 years or the S&P? I think the answer is pretty clear. So I'm not a fan of gold. And again, it comes down to me on a relative basis. I mean, if you look at gold relative to the S&P 500, that's the most important part. And so gold outperformed the S&P while the dollar was falling. But since the dollar strengthened over the past 10 years, you can see gold up until recently, gold had been downtrending. So if the dollar bounces again, I just don't see this relative strength line moving up. So I think we got to be careful there. All right, moving on, relative strength. I just wanted to pull up the financials. First of all, on a relative basis, let me move over here to the XLF. On a relative basis, we're starting to see the financial strengthen. And really, since the vaccines rolled out, that's helped the financial group. And if you think too, I mean, banks, they've got a lot of loans from companies that were severely impacted by the virus. And if all of a sudden we start rolling out these vaccines, some of these companies that maybe are teetering, if they start to strengthen, that's going to help the bank's balance sheet, loan loss reserve, and so forth. They're going to be able to start lowering that loan loss reserve, and that's going to help generate profits. The other thing that'll help generate profits is the 10-year Treasury yield moving up. I mean, if we look at this, I'm going to come down here to the bottom here and do the correlation with the S&P 500. So this is going to be a correlation with how the financials do relative to the not the S&P 500. I wanted to do the 10-year Treasury yield. So this will tell us the correlation between the 10-year Treasury yield and the relative strength of financials. And I'm going to go back. We'll do this. We can do it daily. Let's do 10 years. Let's see what's going on here with this. Well, daily's kind of all over the place. Let's do the weekly. That'll smooth it out a little bit. Whoops. Keep hitting all the wrong buttons. Weekly update. All right, so over the last 10 years, I think you can kind of get the picture. The correlation, when the 10-year Treasury yield goes in a certain direction, so too goes the relative strength of financials. So when you're going up in terms of the 10-year Treasury yield, we tend to go up in terms of the relative strength of financials. And recently, you can see that relative strength picking back up again with the vaccine and then also with the 10-year Treasury yield moving up. So today, with the 10-year Treasury yield up another 6 basis points, I would absolutely expect a big day out of financials today. And if you want to know one reason why NASDAQ is lagging in the futures, that's a big reason. The NASDAQ 100 has very, very little financial representation. I think maybe a couple financial administration stocks. But there's no banks, there's no investment services, there's no asset managers, anything like that in the NASDAQ 100. So the fact the futures are so skewed this morning, I think tells us that financials are likely to have a very strong day, at least at the opening bell. Now, I believe we're in a secular bull market. And I think the more important thing is not necessarily where we open, but where we close. And so many of these NASDAQ stocks that are going to open lower, I'll be watching just as I have for the last 10 months at whether or not they rebound. We saw it 2 days ago, back on Monday. Remember, we were selling off. It looked like Dow was down 700, NASDAQ was down a couple hundred. Looked horrible. But the last 3 hours, we rebounded. And if you noticed, I don't know if you noticed, I think it was the spider. Yeah, I mean, look at the spider. Look at the accumulation distribution. Had this big day, but we didn't really take a big hit. The reason being, we bounced off the low and we finished about in the middle of that candlestick. That's where we closed. That's the multiplier. Where you finish relative to your high and low is your multiplier times the volume. The volume was very heavy on Monday, but that rally meant that we had a very, very small impact to the AD line. And then yesterday when we went up, we finished near the high. So almost all this volume gets added and we're ready to break out again on the spider, even though it looked like a lot of selling. So I think the whole theme that played out back in April and May with prices going lower back in March and the AD line not going lower and then continuing to trend higher, I think that theme continues here into 2021 so far. The headline news drives drives prices down at the open, and then we rally. And so again, looking at futures, yeah, I know it's, I've got a lot of NASDAQ stocks, probably not going to have a very good start to the day, but I'm worried more about how we finish. Is it a day where we gap lower and there's heavy distribution? That's a much worse situation than where we gap lower, move lower during the day, and then come back at the end of the day, maybe even rally into positive territory. Who knows? That's a completely different animal. So that's something to watch for today, is whether or not we're going to have that bifurcation at the open. We're obviously going to see the Dow and the S&P outperform the NASDAQ. Small caps, mid caps should get a really big boost. But what happens during the day? Do we see that continue and balance of the week and next week? There's a story that still has to be told here. Don't just look at one news article or look at one election result and go based off of that. All right, seasonality. I just want to point out two quick seasonality charts. One is the aerospace group, which when you look at this, you go back 20 years, you see, okay, it's been up 65% of January's and average is going up 1.3%. You think, okay, that's a good month, but that's not really anything special until you look at it relative to the S&P 500. And then you see it's up 60% of the time and 1.6% average outperformance. And if we look during this bull market, just the last 10 years, you can see January and February tend to be pretty strong months for aerospace. So that's something that you probably want to keep an eye on. Also, gambling stocks. If we go back 10 years here, look at January. 8 of the last 10 years, gambling stocks have outperformed the S&P 500, and they've done it by an average of 2.7 percentage points per January. That's better than any other month during the year, topping even November. I noticed gambling stocks, I think, were the best performing group in consumer discretionary yesterday. So if you got some gambling stocks you like, maybe making breakouts, that might be an area, if you're a trader, that you might want to take a look at. I wouldn't be shocked to see that continue to move higher. All right, mailbag. Question that comes in, I'm going to tread very lightly on this question. What impact will the Georgia Senate races have on the stock market, especially if the Democrats win both seats? Well, as you probably have heard or know, unless you've been under a rock or maybe you just don't care about the political environment, if the Democrats win both seats in Georgia, the Senate will be split 50-50. And in that case, the presiding vice president will have the tie-breaking vote. So if the election is certified, Biden wins, Kamala Harris is the vice president. She would have the deciding vote on issues where the Senate is split. So clearly the power has shifted a little bit. Now, I don't get into political discussions. I can tell you I'm kind of middle of the road. So I'm not in favor of the far left or the far right. I think the stock market does better when we have policies that appeal to the middle of the country, because you're impacting more people in the middle than you are if you start leaning to one side or the other. And history backs me up. This isn't just my opinion. I've gone back and studied history. Some folks say, well, if a Democrat gets in the White House, that's bad for the stock market. History wouldn't necessarily agree with you. Democrats actually have a slight advantage in the White House over Republicans in terms of stock market performance. So that's an old wives' tale. Just like, I remember back in 1980 when Carter and Reagan were running, and my mom always talked about, she was on disability and she had Social Security, and she kept talking about, wow, I'm going to lose my Social Security if Ronald Reagan gets elected. And that seems to be the Democrats' theme, as you go into each election. Everybody's, you got your own kind of, you got your own ammunition, I guess, as a party, and, you're trying to appeal to your base and so forth. But, Social Security is still in play 40 years later. I mean, it's what each party tries to do to try to get elected, whatever. I believe everybody's entitled to their own vote, voted however you wish, and we should all respect everybody else's vote. Now, as far as the Democrats winning these two seats, if they do win these two seats, a lot of folks said, well, the market's going to crash. I don't believe that at all. I think we're in a secular bull market. Now, what I can tell you, again, based on history, based on fact, is that when one party controls the White House, the Senate, and the House of Representatives, the performance in the stock market is less than when there is power divided. Not that it's negative. So again, I'm not saying that, hey, we should expect some kind of a down year, but history tells us that it's lower. And my interpretation of that is when one party is in charge, and I don't care if it's Republicans or Democrats, again, I think the country begins to lean a little bit more toward one side or the other, which impacts a greater number of people to the downside. So I think we have to be careful there. But I don't care what happens in Georgia. I still believe the stock market's going higher. And I think, again, we have to wait and see if the Democrats win both seats, what are the policies going to be? I think one thing you can almost count on is higher taxes. That would be the one takeaway. The Republicans would not be able to block Biden's initiative. And the thing you have to understand, some people are really concerned that the far left is going to kind of, flex their muscle. There are a lot of middle of the road Democrats that do not favor that side of the party. So I don't worry about that. Just like same thing on the Republican side. If Republicans were in charge, you've got enough middle of the road Republicans that you can't take things too far to either side. And it's one of the things I really appreciate about our country and our structure. But anyway, my answer to that, and again, trying to avoid all political discussions and debates, because I try not to get into those. I look at it how it impacts the stock market, how it impacts our earnings beats members, and that's what I care about. And I still believe we're going to go higher, regardless of what happens and what is finalized in Georgia. Lastly, 3 you must see. Let's move on to, I'm going to give you 3 financial stocks because of what's going on. I think, financials could really be in play here. One stock that made a pretty good move, volume's been rising, and you can see that the uptrend that's been in play here is Deluxe Corp, DLX. And when I look back and we inspect since the March lows, all the problems we had, well, in this case, the stock actually went below the March lows, but its rebound has been 31.13 on the close. Yesterday, we closed at 31.50, and you can already see today's gap up. So DLX looks pretty good to me. I wouldn't take a full position if I got in. And this is, I haven't looked at earnings or anything. I don't know if it's on our strong earnings chart list. I'm talking strictly from a trading perspective. Momentum trader. I see a stock that's been moving higher. It's taking up key levels. If I were to get into a trade like this, I would only have a partial position. And the reason being, sometimes you get these false breakouts and then you come back down. And if this stock were to go back down now at this point and hit a rising 20-day moving average, that's where I'd fill out my position. If it closed below the 20, I'd get out, take my loss, small loss on half a position. So that's how I look at it. Next up, a smaller company. This is MoneyGram, MGI. This is a stock that was really moving back in October and November. And you can see kind of went through this ABC correction. And now it's starting to strengthen again. I would watch, it's sitting almost right on the 20-day moving average, which I think is kind of interesting. If it is beginning a new uptrend, this could be a nice entry point. But it is a small company. It's going to be very volatile. If you look at the stock, it was $2.75 at the end of September. It was $9 2 months later. And then less than a month later, it was back to $5. So just understand, you've got to have a strong stomach and be willing to accept this kind of volatility to go into a stock like this. If you don't like stocks like MGI, then stick with the next stock, which I also like, and that's JP Morgan. JP Morgan, I think, is one of the best banks. I think when we start taking a look at relative strength, it's pulled back a little bit the last couple of months, but overall, this is a stock that tends to outperform long-term relative to banks, relative to financials. So this is a stock I expect to do well. If the 10-year Treasury yield, if I'm right, and we do move higher, I think that is going to help a stock like JP Morgan. So those are your 3 you must see. That is a wrap on today's show. Appreciate everybody tuning in. And I'll be back tomorrow with a recorded version of Trading Places Live over at Stock Charts TV. That starts tomorrow morning at 9 a.m. Hope to see you there. Happy trading, everybody.